The Fed is begging for inflation, guys. Today, the Federal Reserve's chairman, Jerome Powell, came out and said he intends to keep interest rates near zero for as long as necessary until the economy bounces back and is in full recovery mode. The Fed intends to keep interest rates near zero until inflation meets or exceeds 2%. Currently, they expect that to be 2023. They're going to keep interest rates near zero until at least 2023. So what does this mean for investors? This means that the Fed is going to do whatever he can to help the stock markets, the labor markets, the financial markets bounce back and continue to prosper. He is going to do whatever he can, whatever is in the Federal Reserve's power to encourage economic growth. The Fed thinks that we're not anywhere close to out of these woods. He thinks that we have a long way to go, and they're going to have to do whatever they can to keep the stock market going up, to keep the financial markets going up, to keep the labor markets going up. They want to reach maximum employment, what they deem to be maximum employment. I find it pretty funny that there's such a thing as maximum employment. They expect that not everyone can be employed, so there's a rate at which they deem there's maximum employment, right? The maximum level of employment that they believe is possible in the economy. So until we reach that, until we get to that point or close to it, until inflation reaches at least 2%, we are going to keep low interest rates for at least until 2023. If you're an investor, this is great news for you. The Fed is doing whatever they can to prop up the markets. They're doing whatever they can to keep us out of recession territory, right? That's the Fed's job, to encourage economic growth and get us out of recessions and to stabilize the economy when it's unstable. The markets are doing pretty well right now, but the Fed is concerned that at any moment we could reverse back down to the times that we were in March and April of this year, back into a recession. And that is the opposite of what they want. The Fed is asking for more inflation. The Fed is asking for more business activity. The Fed is asking for more investments in businesses and in employment, right? They're asking our elected officials to do whatever they can to get this economy back on track. They're begging Congress to pass a stimulus bill, to pass something that's going to get people back to work and back to spending, right? Because the economy revolves around spending. When you spend money, somebody else makes money. And when they make money, they pay somebody else for services, right? And those services include jobs, right? Your job is a service to your employer. But if your employer cannot afford to pay for your services, they have to let you go, right? So if we don't spend money, businesses don't make money. And when they don't make money, they have to cut jobs. They have to cut expenses, right? So the Fed wants us to be spending our money. They want more stimulus. They want more inflation. And they're going to do whatever they can to get it. They're begging for inflation. They even changed their policy framework around inflation. Instead of trying to reach 2% every year, they now are saying, hey, we're going to be more flexible. We're going to let inflation go above 2% if it misses that target in the years prior. So if we don't reach that inflation goal, they're going to continue to let inflation rise up above 2% for as long as they need to reach their average of 2% over a period of time. So if you're an investor, this is great news for you because you can bet on the Fed doing whatever they can to keep the economy and the markets going up and keep the stock market going up, the financial markets, right? And of course, jobs, that's their ultimate goal, to build up their labor markets to a point where they believe maximum employment is reached. These are the Fed chairman's own words. So in the short term, this week, next week, or next month, we might not see the effects of this new statement from the Fed, this reassurance that they're going to keep interest rates low, near zero. We may not see that affect the market positively for a while, but in the long term, the Fed believes that this is what's going to help us escape any recession territory and get back to a strong economy. So as an investor myself, this is great news. This is music to my ears because I can trust the Fed will do whatever they can to keep the economy from crashing back down, to keep the stock market from crashing back down. So I can be a bit more bullish, right? I can take a bit more risk because I know the Fed is doing whatever they can to keep the markets moving up and to the right. So this has been a quick video just to update you guys on the Fed's policy. After a policy meeting of 2 days, they came out and said, this is our plan and this is how we plan to proceed. Low interest rates until inflation picks up, until the labor markets are strong again. So thank you for watching this video. If you enjoyed it, like the video below, subscribe to the channel, and hit the notification bell so you know the next time I publish a new video. And if you have any thoughts on this Fed's policy on low interest rates and higher inflation, then comment below what your thoughts are and let's talk about it. And if you're concerned about inflation, let me know below in the comments and let's talk about that too, right? Because inflation is good for the economy at moderate rates, right? Inflation is a good thing. The opposite of inflation is deflation, and that's a terrible thing, right? As long as we have moderate inflation, we're fine, according to the Federal Reserve's monetary policy. I'm Lincoln with bullacademy.org. Thank you again, and have a great day.